Retire into the stock market, part 2, session 8 with Kerwin. How are you, Kerwin?
Doing well. How are you?
Pretty good. Netflix went down 55.
Everything went down quite a bit. Yeah.
I say it's a buying opportunity for the short term. Short term meaning want to pick up some Netflix shares if people are doing a cover call or if they're going long term, you can pick up some shares, but I don't say it's a buying opportunity long term because the whole market could go down more.
Right.
You know, if you like the Netflix shares, you can pick up some shares, but down 55 is not a normal down for Netflix, like 10%, right?
Right.
I think it was getting the earnings and it was good, but it wasn't good enough. You know how that works.
Right.
However, I'm still positive on Netflix. I think the all-time high was around 700, and I think it'll eventually get back up there and pass it. It's just going to take more time, more patience. Be willing to ride that roller coaster ride with some of these high-profile stocks. Netflix, the video was down like how much?
Quite a bit, often.
Yeah, this was down like 80. Right. Can you pull up the video for me?
Yeah. Down $84.71.
Give me the price.
762 even.
762 down 84.
Yes, 84.70.
And let's cover Netflix too.
All right.
5.
555.04 down 55.52. Man.
And then let's do Tesla.
Tesla is at 147.05 and they were down $2.88, 288.
Okay, now I want to tell you something. You see how these techs are down pretty big, but then the Dow Jones is up 200?
Yes.
Let's put that down. The Dow Jones is 37,986 plus 211. So what's happening is some of the big traders, investors are selling these high flyers, NVIDIA and Netflix, which have gone up. And even Tesla, Tesla's still in a downturn.
Yes.
Or go down more.
Yes.
And they're putting money like in Coca-Cola and these other Dow Jones stocks, which are more, let's say, more stable, bigger, fatter. It's perceived to be more safety. Does that make sense?
Right.
So the first thing to go in a correction are the techs. Write it down. First thing to go in a correction are the techs. First sector or group of stocks to go down in a correction are the tech stocks. In a correction are the tech stocks. Now, that doesn't mean that we're going to have a correction right now. It just means that it could be a signal. It could be a precursor to what's coming next. And then when it happens, let's say minus 10%, minus 20%, and then the rest of the stocks, let's say the Dow Jones. Dow Jones comes down last. It's last. That can come down, 10, 20, or 25 on a regular correction. So, like, if we consider we almost hit 40,000, right?
Right.
25% reduction from that. If we almost hit 40K in the Dow Jones, a 25% reduction from that is what?
40. You're doing the math.
Well, I could just go by basic math, like 10% is 4 points.
Right.
Or
Right.
4K, which will be 36, and 20% would be 8, which is 32. And then the 0.5% would be 2 more, which is 30. So 30K. Okay.
Okay.
So from 40K, you always go from the top where it was. You count the correction to the last high, right? So it could go from 30K, 40K to 30K in the Dow Jones, which would be significant. Not a doomsday, but it could be like a significant return. And then the tech stocks will be down even more. Let's say 30%. Dow Jones down 20%, 25%. The tech, let's say 30% to 35%. Write that down. So those are the Teslas and the Nvidias and the Netflixes. Now, those are the good stocks. Okay, I'll tell you. Some of these no name, some of these I'm gonna call them air bubbles, smoke, puffs of smoke, with these other inflated stocks, which let's say have no earnings, have no have no criteria, we're looking at market cap, we're looking at volume, we're looking at 10-year chart, we're looking at stock share price is high, $100, $200, earnings is to have profits. So these are all criteria, right? The other stocks don't have the criteria. Those ones are off, 40%, 50%, minus 40 to minus 50, straight. Or that stock that you wanted on the what's it called, the Russell 2000.
Yeah.
That one might be off more in a correction.
Right.
So you got to be prepared for that.
Right.
So you see the perspective. The Dow Jones is still going to be the safest. We're going to have the less return, the less loss. But on the upside, the Dow Jones stocks aren't going to have the same growth, like Nvidia can have, like Netflix can have, and that's why I think that's probably why you're looking at one of those Russell 2000 stocks. They're going to have the growth like in long term, in 5 years, 10 years.
Right.
Only if you get a great stock.
Right.
It's hard to find, the next Apple, the next Amazon, the next Google, because it takes, 1,000 stocks to get a good one, honestly.
Yeah, of course.
A really good one.
And I wasn't trying to find, I was just trying to find a company that actually has some growth potential. You know what I mean? Not necessarily, I'm not looking for exponential growth. Now, if I found that would be great. But I mean, I wasn't looking for anything with exponential growth, just growth potential. You know what I mean? That can grow over 3 or 4 years, and I can just hold on to the stock. You know what I mean? So, but it was just a thought. You know what I mean? So, still ain't found the one I'm looking for yet. So I'm still looking.
A growth stock is something that can go up. Let's just say it could double in 3 to 5 years. Write that down. Can double in 3 to 5 years. And the way you find that stock is you look in the last 3 to 5 years and see if it already has doubled. And that's one of our criteria is. One of our criteria on the top 11 criteria is can it double? So one way to find what you were looking for is to have a stock that's already doubled in the last 10 years. And if it still looks like it's going, that could be the next stock to double in the next 10 years. Ideally, they don't have so much market cap, like Apple example, which is like already fat, already big.
Right.
But they think Nvidia can double and triple again because of the AI.
Right.
They think micro supercomputer can double and triple again because of the AI. So you have to just use your best judgment.
Yeah. Well, like with that micro supercomputer, like its growth was so quick and kind of exponential. I'm kind of afraid to touch it. You know what I mean? Because Didn't know if it was going to drop just as fast as it ran up, or what it's going to do. So
That's
that's
right.
really kind of just stayed back off of that one, just left it alone. So
That's right. Okay, you talked about. Okay, you think one of your questions. You think Tesla may go down to 105? I thought you said that, right?
yes,
And right now it's at 147.
yes,
Now let's say it does correct 105, and you want to benefit from that. You want to look at the trade, okay, from that, right?
right,
Let's talk about that. So, what the professionals do is they play both sides, okay? Why? Because for one, they can't afford to lose money.
right,
So, if you have these investors who have money, they have mutual funds, which is what they have pensions from people's jobs. They have 401ks. They're managing money managers managing $800,000, for example.
right,
They have to buy these stocks and they have to make money. So what they do, they play both sides for like Tesla, for example. So you
right,
have, you have the shares of Tesla. You have call options, okay. But also you can go short, okay. Now
right,
we talked about cover calls. Cover calls is one of the best trades in the market.
right,
Arguably, probably the best trade in the stock market. A lot of different reasons, but one is you get to take advantage of long and short, because if you
right,
have the shares, you can get some value from the shares going up.
right,
As long as you write the cover call above the strike price. And when you get paid on the calls, so you're short the call, you're getting basically money back for the future, right? So you do like
right.
a 1 month call or a 3 month call, you're getting money back. Can we look at some examples?
Oh yeah,
Let's look at Tesla. So Tesla is 147 right now.
right,
147.05. Now, last week I remember we talked about deep in the money cover call,
yes,
like on Palantir. Oh, Palantir went down, didn't it?
it did.
Let's pull that up. PLTR. Give me a price and the change for Friday.
Uh, Friday the price is 2047, and it went down 66 cents on Friday.
20. Say it again.
66 cents. They're 2047, and it went down 66 cents on Friday.
Isn't it funny how I said it might go down to 20? Did I say that?
Right.
So your job is to roll with the stock if you still like it. I hope you do.
Oh
But
yeah.
also get that money, which is to write cover calls. Now, we talked about last week to write a deep in money cover call. So if you think Palantir's coming down more, Tesla's coming down more, right? Like
Right.
with Tesla, well, let's look at Palantir. Instead of writing the 21, 22, 23 on a monthly basis, we can do like in the money or at the money, like we can write like the 20. Because look, we can write the 21, 22, 23 and get like what 7% return.
Right.
But then if the stock goes down, 20%, how much do we really make, right?
Yeah. Right.
You understand how that's working.
Yes.
So what you do if you think the stock's going down in a correction, you play both sides. And here's one strategy, right? We're going to do a in the money cover call, or just put deep in the money, because this is one way to say it. Deep in the money CC cover call. Now you can do monthly because that's what we do monthly, make the monthly income. But
Right.
like to benefit more from a down market, you can go 3 months out. Okay. Let's
Okay.
just do this, for example, 3 months out. So let's do Palantir and then let's do Tesla. Okay.
Okay.
Now Palantir's still making great money on the cover call, am I right?
Yes.
It didn't really dry up so much. If you look at let's look at this. Let's just say you wanted to get into Palantir here at 2047. And let's say we're gonna write to 22 cover call. And this is April 20th. So let's look at May. Let's look at the May cover calls for the 22. What are we at?
We're at 120. 120 by 121.
So divide 120 by 2047, please.
You got a 5.86.
Still a great return for a month.
Right.
However, we're gonna fulfill your question. And what do we do when the stocks are really coming down? Now you know that you can get $1.20 or $2, whatever you're getting. But then the stock drops, 6 points. If you get $1 or $2 premium, which is your income from the covered call. But then versus stock dropping 3, 4, 5, 6 points, and what's happening, right?
Right.
The first lesson is to dig yourself out of the hole, with the next cover call. So you can just keep writing cover calls and dig yourself out of that hole. If you consider you're going to write 10 cover calls, and you're getting $1.20, because I can write 10 cover calls in a year. You follow me?
Right.
If you get $1.20, that's 12 points to go that way. So if my price is 20, 12 points brings me to $12 to $8. Okay.
Right.
And I did this exact trade with Twitter before Elon Musk bought it, when it was having some troubles.
Right.
I was doing that roller coaster, but I was digging myself out of the hole that the stock was going down. I was digging myself out of the hole with the cover calls.
Right.
Just write that down. Dig yourself out of the hole with cover calls. There's yourself out of the hole with cover calls. PCs cover calls. Which is to say that we were talking about Palantir at 26 last week, I think.
Right.
We're getting like $2 or something, which is great. But then it's coming down. Actually, it was last week. It was a few weeks ago because we had a break.
Right.
So while the cover call is beneficial, it gives some protection. If you notice, it gives some protection. When you do the cover call, it gives some protection from the falling share price. Because if we're short at $2, let's say the stock is 26, and we were up to 28, and we got $2. Now the stock goes down to 20. Okay, now $2 is now like 10 cents, right?
Right.
So we basically had protection from $190, 190. Okay, but then we've lost in the share price. Okay?
Right.
So now back on what Tesla may do or may not do, and what Palantir may do, may not do. We're gonna change up. I'm gonna show you this strategy. We're gonna go 3 months out. We're gonna do at the money or in the money. Okay, this is gonna give us more protection. See, we can still benefit. Okay, if the stock goes up,
Right.
because we're gonna get income, but we're getting more protection from it going down. Okay, keep that in mind. Okay, let's go 3 months out. So instead of May, we're gonna go to July. So let's look at Palantir July. And let's just look at the 20, okay? We're gonna lose. We're gonna straight up lose. Actually, no. Let's just do that. If it has a 21, tell me it has a 21.
21, yes.
How about 22?
It has 22.
Let's do the 22 first.
All right.
How much is it?
191.
191 for July.
That's for July, yes, sir.
Okay, let's do the 20.
Right, the 20 is 274.
274. Okay, so let's observe the July 191. Okay. I want you to double check that you did that right. You're looking at the July 22 call for Palantir.
Yeah. 19 July, yes, sir. And 22 is 191.
And then go back and look at the 20. Which one do we do for May? When I had you look at May, was it the 21?
Yes.
Go back and look at the 21 for May.
157 for the 121. The 22 is 120. That's when you had me do the 22. No, May.
Okay, so just to be clear, we're gonna get 120 for the 22 for May, and we're getting 190 for the 22 for July.
Right.
Okay, that's still a decent amount more, but I thought it would be a little bit more. That's okay. So let's consider the 20 right now for July. So here's what you can do, like the Tesla over Palantir. If you're gonna get 274, that's like adding 274 to the 20. You're gonna write the cover call and gonna write the 20 strike, you get 274. That's like saying you can agree to sell the stock at 2274. You follow me?
Right.
And it's 2047 at this point. So we're gonna automatically lose 47 cents of share growth. So you get 274 and then put minus 47. 274 minus 47 is how much?
74 minus 47 is 227.
All right, so it ends up being $227 per contract, or $227 per share income for the July. Okay.
Right.
Now that's good income, because look at this. Divide 227 by the share price of 2047, and what do you get? If you're coming into Palantir at 2047, you're buying it, and we're going to agree to sell it.
Mm-hmm. Looking at
227 profit.
Looking at about 11% return.
11%. And that's the kind of return that you were looking at originally. So it is maybe getting a little bit dried up. 11%, 11%. It basically gives you an income of $227 per contract, 11% return for the 3 months, right?
Right.
And that's one way to play it. It gives you protection. So like if the stock were to go down 227 or below 227, so that's like 73. It's a wash. Okay.
Right.
So you won't actually lose unless the stock goes down below 1773. You follow me?
Right.
So that's more protection. Okay. Understand?
Right.
So that's one way to play it. You're still going to benefit with this premium. You're going to get more protection going on a 3 month. In this case, it's at the money, in the money. 20,
right.
So let's do Tesla, shall we? Let's go to May. And now, the thing about Tesla, like if you really think it's going down, you could, buy a put, right? Or you could just not trade it, because if you're long and it's going down, you're going to lose money some way.
Right.
But the value of writing the cover call 3 months out at the money or in the money is that you can actually be wrong and still benefit. Okay.
Right.
But what if Palantir goes up? You still get 227, 11% return.
Right.
But Kerwin, like if you can make 11% return even every year, you could retire in the stock market. You could do this for a year.
Right.
Because what? You can get 100, 200, 500K, about $1 million. That's $110,000 right there.
Right.
I'm sure you're going to make 11% in 3 months.
Yes.
And if stock goes down, you'll be okay down to 1773. You see?
Right.
But if stock were to shoot up, you'll be okay because you still get 11% return. You're going to sell your shares at 20. Total premium 274. You're going to lose 47 cents on the share growth. You're going to get 11% return at 227. So the value of the cover calls, if the stock goes up, you'll still be okay. But when you buy a put and the stock goes up, that put's going to get slammed, right?
Yeah, of course.
Okay, so let's do Tesla 147. Let's just say, can we just say 140? Because I don't want you to be wrong.
Okay.
But let's just start with 140 in the money, okay, and go down to July.
We'll go to July.
Yeah. And what do we get on the cover call?
The 140 is 2055.
2055. Now we're going to give up for $7.05 on share growth.
Right.
So subtract 20.55, then subtract 705. 1350.
2055 minus 705 is, wait a minute. Fine. That's 13.5.
Now, let's divide 13.5 divided by 147.05, which is our buy price. You come in here, 500 shares Tesla at 147.05. Write the cover call for the 140 for July, 3 months out. It'll get 1350 profit. Okay, you're gonna get 2250, but you're gonna sell it at 140, which gives us 1350 profit. And what's our return?
9%.
Okay.
0.09.
9.02.
No, 0.09. Yeah, 0.91. That's what it is. 9%.
9.1. Hey, don't cut off my one. Don't cut off my 0.1.
I got you.
Give me that 0.1, 9.1. Okay.
All right.
Don't even try. I mean, like all those 0.1s, like there's a movie back when the Superman, when the dude Richard Pryor, he got that half a penny for all the paychecks. He's like, the half a penny. Where'd that half penny go? And he got raked up some money. So don't take away my 0.1.
Gotcha.
9.1%. So similar to Palantir, but knowing that Tesla's a much bigger stock, it's perceived to be safer. Oh, I'm sorry. I meant to do Reddit.
Reddit. Okay, you want to do Reddit?
No. Let's finish Tesla. Okay, so you not look at who wouldn't want to buy Tesla here at 147. Agree to sell it in May for 140. Get 2055 minus the share growth. It equals 1350 points, which is 9% return for 3 months. Who wouldn't want to get that for 3 months?
Right.
The thing is so that's $1,350 per contract. Okay.
All right.
13.5 points. And what it gives us protection from the falling market.
Right.
So since we know we get 1350, we subtract that from 140. So we're good till 126.50. Right?
Right.
So for 3 months, we're good for 126.50. We're gonna get 1350. You can go deeper in the money, right? But their return's gonna be less. Okay.
Okay.
When you go deeper in the money on the cover calls, it gives you more protection, but the return's gonna be less. Okay.
Right.
Now, like I said, I'm showing you 9%, 11% return. What the millionaires do, okay, is they're gonna go deeper in the money. They only want to get 5%, right? But then they're gonna cover themselves to 120, 110, 105. Right? You can set this up to 10. I'm gonna write the 105 cover call. If I really think it's gonna go to 105, write the 105 cover call and get what? Get paid for it to go to 105 and not really have any share loss. You're gonna have a premium at the end because you're gonna have a profit at the end because the options are still gonna pay.
Right.
See?
Right.
But the return's much less, right? They're trying to pay your bill. So even if you're wrong on Tesla going down, you're still gonna get 9% return and you're still gonna be covered to 126. So that's one way to do it. Okay.
Right.
You wanna look at Reddit now?
Sure.
Let's look at Reddit. Pull it up, give me the price, and then let's go 3 months.
And Reddit is at 40.88, down 84 cents on Friday.
RDDT.
Yes, RDDT.
40.88.
40.88, 84 cents on Friday.
Now, didn't we say Reddit can go down to 40?
39, yeah, but for me to
but like I remember saying Reddit can. I think you had that 46.
Yes.
And I said it can go down to 40. Remember? And
yeah.
you were getting like 290 for the cover call. How much?
No, it was 690. Because it was like a 14% return.
Okay, so let's go in the money for Reddit, can we?
Okay.
Let's go out to July. And let's just say, let's just say 35. Let's say could drop 5 more points.
Oh yeah, it can for sure. The 35 is 870.
870. Now, that's going to be 5. How much is the go below 35? What do we have below 35?
37.5, which is
No,
650.
below.
Oh, below is you got the 32.5.
Okay, it's right there, the 32.5. How much is that?
10.
10. All right, so let's look at this is deep in the money cover calls. And if we go to the now, let's just be clear. What normally we would do, okay, because we're in a good market, you know, we think the stock can go up. We can do Reddit, let's say 42. How much is there? 42 for July? I'm sorry, is there 42 for May?
For May?
Yeah.
Okay, I was in July. I thought you was wanting to do July.
Yeah. But I'm jumping back.
Okay. And for May, they got a 42.50.
All right, so let's do the 42.50 for May. I'm gonna compare May.
Okay.
All right.
That's
How much is that?
340. 340.
Now, that's a great return. I want you to buy 340 by share price of 40.88. How much is that return?
That's 8.3.
8.3%. So okay, we can get 8.3% return in 1 month on the cover call on Reddit. Okay.
Right.
Which is equal to $340 per contract. We come in and buy 100 shares at 40.88, right to 42.50 cover call for May, which is 1 month out.
Right.
For 340, which is 8.3%. And if we can write 10 cover calls a year, the 8.3% translates to an 83% return. Okay.
Right.
However, we got the share growth problem. We're in the declining market or in a declining stock.
Right.
And it may continue. So you have to balance your 83% return from you having to ride the stock in a roller coaster.
Right.
You have massive share growth loss. I know it went down like 6 points in the last month, for example. Am I right?
Yes.
So you got to be able to manage this trade month to month. And if we're down in share growth, we write the cover call to dig ourselves out of that hole. Make sense?
Right.
Now, if we think it's going to go down more, like let's say Tesla may go down more, if we think Reddit's going to go down more, we can do the 35 or the 32.50 for May. And for the 35, for example, we're getting 870 for the 35, but then we're going to lose we'll lose 588 in share growth. 588 share growth issue. Okay. Because we're buying it at 40.88 coming in today, and we're selling it at 35, cover call deep in the money. We're getting 870, which is 588 loss. So we're going to let's do the math with me. 870 minus 588. Where we at?
That's 2.82.
282.
Sure.
So that's our true return.
Right.
282. So it's about 282 by 40.88. What do you got?
That's 6.8%.
6.8%. Now, who wouldn't want to buy Reddit here today?
Right.
At 40.88. Get 870 for writing the 35 cover call deep in the money for May. I'm sorry, July. This is July. All right, July.
I think those numbers are based on the May number.
No, we're doing July. Let's verify. 35 cover call at July at 870. Is it July or is it May?
Okay, you're right. That's July.
Okay, so who wouldn't want to buy Reddit here at 48? In 3 months, July, right, the cover call for 35 to 870, which is ends up being a true profit of 282, which is 6.8% return.
Right.
Right. So that's $282 per contract, or 282 per share.
Right.
And it protects us to what? What does it protect us to? We're gonna write to 35. We're still getting 282. So what is that? What is our break even?
35.
It's 35 minus 282. So what is that?
That's 13.
3118. No, not percentage, because look, we're looking for our break even. The break even is 3118.
Okay.
Why?
Yeah.
Because
So it's 35 minus 588, right?
no, it's 4088. Okay, on the
Okay, you're
588.
going with the actual stock price. Okay, so 4088 minus 588, which is
You mean
the
to get
difference.
to get to our break even?
Yes.
Well, okay, let's start over. Okay, consider the premium 870, correct?
Right.
Now, that's a great premium, but we're agreeing to sell it at 35. So we have
Right.
a share growth loss of 588 on the share growth.
Right.
Okay. So we have to subtract the 870, which is our premium, take off the share growth from that, which is a loss, and we get 282, correct?
Okay. Yes.
So 282 is our true profit.
Right.
And the break even is going to be $35, because that's what we agree to sell that, minus 282, which is we're giving up our profit to find out our break even. And I get
Gotcha.
3118.
Gotcha.
In other words, if we come into Reddit today at 4088 and we write the 35 cover call, our break even is going to be 3188. We're good. If this stock stays above 31,
Right. We're good.
3118, we're so good because we have what? Profit.
Right.
So the value of writing the deep in the money cover call and going out 3 months is that when they get great premium, 6.8% in this case, and we're protected all the way down to 3118. So we can lose 9 points on this stock. Actually, yeah, it's still in profit mode.
Right.
So this is how you deal with a falling market, still being able to make money, still being able to make a premium, and protecting ourselves from the stock going down.
Which
We
is
did it
good.
in Reddit. What?
I said, which is good.
We did it in Reddit. We did it in Tesla, and we did it in Palantir.
Right.
Now, what are we doing? We're being more safe. We're giving up premium, so less premium, but we're being more safe. So we're
Right.
protecting ourselves from the downside. We're exchanging for that. We're exchanging premium. Okay. Now we got to listen. We got to make money regardless. Okay.
Right.
We still get that premium. Okay. However, there's no guarantee the stock will maintain above 31. Let's just say we do have a correction. Let's say we do have a correction. Okay. Stock could go down below 31. Okay.
Right.
If we talk about Reddit, which we know is no profit, right? We know that, right? There's no profit in Reddit, correct?
No profit on it.
Or is there a profit?
Right.
So no profit. We're gonna lose 30, 40, or even 50% return on a from the high. So what was the high in Reddit? What was the high in Reddit all-time high? We just had the IPO just came
I think
out.
it was like 79 or something. Let me look to find that.
Well, that's really not.
The
If it
52
was
week
70 at the high,
it's 74.90 was the high.
okay, so that's going to be hard to rate, because a 50% return, a loss from 70 is going to be 35 points, which we know it could go down to 35. We're protecting ourselves at 31. We're protecting ourselves at 31. I would say let's just do 40% return, 40% loss from here. Let's just say that, okay? If Reddit's $40, a 10% would be 36, 20% would be 32, and a 40% would be 30. So if it goes down to 30, that's a decent correction.
Right.
Okay. And guess what? We protected ourselves at 31. So we already got most of that covered. Like if we did this cover call, Kerwin, we got 6.8% return for July. Protected ourselves at 31.18 to break even.
Right.
People come just like, you're in Reddit, man, you're getting killed. I'm like, I'm not really. I'm only down $1.
Right.
Foxtel, $10.
Right.
Out here in my patio, so I got some cars out here. Sorry. So like Reddit's going down from 40 to 30, and I'd be like, I want to keep the money cover call. I'm only down $1.
Right.
You see, but if we're wrong and the stock stays the same price or goes up, we get profit. We get premium.
Right.
That's why it's better to do the money cover call than to just buy a put, because the put can get snapped.
Right.
So looking at Tesla uses a few different scenarios. You did the 140 Tesla, but it doesn't manifest for you unless you actually do this trade. Now, I know you told me your account size, so you could actually do a cover call on Tesla. You could.
Yes.
And are you level 3 trading or level 2 trading? Because level 3 trading, you can actually do what's called a naked call.
Yeah.
Which means that you don't need to have 100 shares.
Right. I'm a level 3.
Huh?
Level 3.
So you can actually buy 100 shares of Tesla, clear some money, sell some things, clear some money in your account, make a deposit. What do you got to do?
Okay.
So 100 shares of Tesla. And you don't have to have, you can do 90 or 80 shares because you got a negative call action.
Right.
And if you're right, the stock goes down, you're going to have a nice profit in 3 months.
Right.
Back on Tesla, we came in and bought it at 147. We wrote to 140. Again, we got 20.55, which is 13.50 true profit, which means our break even is 140 minus 13.50. That's 126.50. So just for 3 months, you're covered to 126.50. That's another 20 points.
Right.
So above 20 points, you're good. Now you can go deeper in the money curve. You can go 140. You can write to 130, for example. Okay.
Right.
You can go all the way to 105 and still make money and still be protected if it goes to 105. Can you imagine that?
Yeah, right.
That's an awesome strategy, but Kerwin, unless you do this trade, it's going to be like, I don't want you to forget it. This is like,
no, I don't want to forget it.
I might have to change my positions around.
Let me ask you this.
Yeah.
Now Tesla reports earnings on Tuesday. Would you wait till after earnings to do that trade, or would you do it before?
I wouldn't. And let me tell you why. Because a lot of times the earnings are misleading. You can never bet on earnings. Unless you really think that's going to go up on earnings, like for sure.
Yeah.
Well, it's going down. Just write the cover call. Why? Because if you wait, you lose time.
Right. Right. Which I believe it's going down at earnings anyway, but I mean, I'm still, just going to watch it. So,
these options decay over time, Kerwin.
Correct.
And one of the big things we do is we trade time decay. Write it down. We trade time decay. We trade time decay. And if we have a call, whatever, 10 points call, and we wait 1, 2, 3 months, that 10-point call could be at $2, $1.
Right. Yeah.
That's happened, right?
Yeah. Well, yeah.
But if that's if you buy the call. But if you sell the call or write the cover call, that 10-point call goes at $2. We made $8.
Right.
Then if it expires, we made $10.
Right.
So when we trade time decay, we want to be on the right side, which is to be on the short side. Sell the put, sell the call.
Right.
That's my key strategy. That's the best I can teach you.
Yeah.
beyond that, just different kinds of trades with that. Matter of fact, if we have time, we wanted to talk about the straddle, but I think we're getting good meat and potatoes right here.
Oh yeah.
When you trade time decay, you know that when you buy a call or put, that then can go to zero because of the time, but also if the stock moves in the wrong direction, that $10 put, that dollar put, it goes at 90%.
Right.
So we want to be on the right side, which means we want to sell the call, we want to sell that put, we want to sell the option. That way, when it decays, which it will decay over time, guaranteed.
Oh yeah.
That ends up being a profit. If we sold it, I did a core answer about how you make money when you're short a stock, and why you make the money, how it actually works. Do you understand how it actually works when you're short?
When you're short, I'm always up for learning. You say you did. You wrote an article on it?
Let me tell you the layman example, okay?
Okay.
This is good for you and for to our investors watching this video. So we all know we can buy gold or stocks or whatever. If it goes up in value, we gain that value, right? But when we're short, what we do, we come into the market, we sell somebody else's shares at X price, and we buy them back lower. The market drops, we buy them back lower, and we pocket the difference. And the person who had those shares we borrowed from, they don't know we sold their shares short. They don't know we did that. So they lost the money, and we gained the money because meanwhile, when it was going down, we sold it for cash, bought it back for less, we turned their shares. They don't know they lost money. But because we were out of the market, we pocketed that profit. Okay, so let me give you a real life example of how the first short seller, I want you to read my core answers. But the first short seller was created. Okay, so back, ready, sit down. Get your hot Joe and snacks. Okay.
Right.
Back in feudal Japan, back in the day, there was a prince. He had money and lands, right? And he had an accountant to manage his diamonds. Okay. And the accountant's job was to count the diamonds and make the value and to tell him how much money he had. So when the prince came around every month or every year, whenever it came around, the accountant would say, "Prince, this is what you have." So let's say you have 100 diamonds, and the price is $100. Okay, this is the value of the prince's diamonds. He has gold and jewels, but we're just going to do diamonds for now because we're going to do math. Okay. So the accountant, this is the first short seller. Pay attention. The accountant, he sees what? He's at the harbor. He sees a ship coming. Okay. They do like trade route, like they trade with other countries and stuff. And the ship's coming, and he has a telescope. He looks far. He sees that ship coming into the harbor in Japan. Okay. He's an accountant. He's looking over the horizon. And what is that ship filled with, Kerwin?
Probably
diamonds. Now, what's going to happen? Here's the trade, okay? When that ship comes in the harbor, filled with diamonds from some other country, Africa or somewhere, they get them cheap, right? And when it comes to Japan, diamonds are going to go everywhere. They're going to sell them. Price diamonds is going to drop, okay?
Right.
So you foresee a decline in the stock price, and just like Tesla, just like you may foresee Tesla decline.
Right.
It may go to 105. But if it doesn't go to 105, Kerwin, a deep in the money cover call will still make you money. Okay?
Right.
And it will protect you, correct?
Correct.
Okay, back on the short seller. So what you do, the accountant, what he'll do, he'll take the prince's diamonds, which he's responsible for. And if he messes this up, that's his ass. Okay, it's literally his ass. Back in the day, the ass was your life. Okay.
Yeah.
Now you just lose. Your account gets wiped out, but back in the day, that's your ass. You had to have a lot of balls to do this.
Right.
So he goes to the city square. He sells 100 diamonds for 100. How much is that, by the way? 100 times 100.
10,000.
10,000 yen or gold coins, whatever it is. Say $10,000. Okay.
Right.
Now you have cash coming.
Right.
You have cash, 10,000 cash. Not you borrowed it, not really even yours. Okay. That's why you're asking the sling. Okay. Sure enough, the ship gets into the harbor. Diamonds go everywhere. People sell the diamonds because they're going to sell everything on that ship. Price of diamonds does what? Go up or go down?
They go down.
Go down. let's say after a month, it goes down 50%. It goes down to 50. So the $100 diamonds goes down to $50. So it went to half. Okay.
Right.
But now the accountant has to make good on the investment for the prints because those aren't his diamonds.
Right.
So you notice he sold them for cash at 100. That was the initial price.
Right.
Kim comes in, a month later, it drops to 50. Now he's gonna do what? He's gonna buy back those diamonds. Every 100 of those diamonds, buy back for how much?
50. 5,000.
Right. But he had how much cash? Because he sold it for how much?
10,000.
And if you buy it, he had 10,000 cash. And if you buy 50 diamonds at 50, I'm sorry, 100 diamonds at $50, how much do you pay?
5,000.
Kerwin, I love that you know math because sometimes when I do these sessions, I'm trying to teach people math. I don't got to teach you math, and I appreciate you for that.
Oh, yeah. Oh, yeah, no problem.
So what happened? He pocketed 55 grand. All he did is take what he borrowed, it's not even his, sold it for 10, bought it back for 5, because he knew, because he had the telescope, okay?
Right.
Pocketed 5 grand, goes back to the prince's vault. And when the prince comes around, the next session, he can say, accountant, what are we looking at? Well, sir, the diamond's value went down, you have $5,000. Yeah, 100 diamonds, and the value is 50. And I counted for you, that's my job.
Right.
But meanwhile, the accountant pocketed how much?
He pocketed 5,000.
For a short seller.
Yes, sir.
So when you do a short stock, they don't tell the person that has a short stock that someone's shorting their shares. They don't have to do that.
Right.
They just take me or you, and we go into, say, TD Ameritrade, and they just borrow the shares from someone else who has it.
Right.
Sometimes there's a small fee involved for shorting. If you have it for a long time, look into that. But otherwise, that's how it works.
Right.
Questions?
No, I think I'm good.
That makes sense?
Yes, sir. I'm gonna go look up that you said it's on Korea, right?
Core, yeah. I'll send you the link. But
Okay.
it says something like, how do you make money by shorting the stock? Something like that. Different words they use. But I'll send you the link.
Okay.
We talked about Palantir, Tesla, Reddit. What else? We talked about shorting. We talked about but here's the thing, Kerwin. If those diamonds went up, if Tesla goes up, Kerwin, I don't want you to get whacked,
Right.
So one alternative is to write a deep amount of cover call. It protects you from going down. Still gives you some profit. Less profit, but profit.
Right.
But I want you to actually do this trade to get that experience. Okay. Any questions now? Do you want to cover anything else? We covered a good amount.
We did. You gave me a lot to look at this week, so I'll let you know when that trade is completed.
We can take that if you're happy with that. We can take that as a win and then move to next week. Or do you want to cover anything else?
I'm good for now. That I can think of right now, anyway.
Now let me say that I don't think we're gonna have a correction right now.
Right.
I think it's gonna be like roller coaster, down, up, down, up. But you know what though? The stronger stocks will maintain. Okay.
Right. I
do think this is a buy price for Netflix. The strong stocks will maintain. The weaker stocks, will go down. Like for example, Reddit could go down a little bit. Palantir could go down a little bit. But I think, I think the video will probably end up going back up. Tesla, I think Tesla will go up. I'm not sure. Let's see. You think it'll go down 105?
I think they're gonna go lower before they go up. I do. I do.
I think we're gonna go. I think we're gonna go up in Tesla to 165. Not saying for sure.
we may go up and test 165, but before we go much higher than that, we're gonna come down and go lower. And
Okay,
then
fair
from there
enough. Fair enough.
But, I see also Roku reports this week too, so I'll be watching that. See what their
Well,
earnings look
Roku
like.
may go up for the earnings. Tesla, it's funny that like once you have a successful stock that's been around for a while,
Right.
a lot of times earnings they sell off because earnings is never good enough, you know.
Right. Right.
But when you have a stock that's not making it, like Roku, you know, a loss in earnings, but then they have a successful earnings, then it can tend to go up. It's just weird that way.
Right. Right. Yeah. Kind of weird.
Uh, well, let's call it.
Okay. We'll do. All right, Bo. We'll see you next week. Appreciate you.